Good afternoon, everyone. My name is Brooklyn Ray, and today I'll be presenting the Tableau case for Group 2. Our goal of this case was to evaluate how our Nike stock portfolio performs relative to the overall market using a series of financial models. By applying these models to both daily and monthly data, we analyzed how our portfolio returns, risk exposure, and consistency change over time. This first model compares our monthly portfolio returns to market returns using a CAPM regression without alpha. The slope of the line, or beta, measures how sensitive our portfolio is to market movements. A beta of 0.89 means that for every 1% change in the market, our portfolio changes about 0.89%, so it moves in the same direction as the market but with slightly less volatility. The R-squared value, about 0.14, tells us that only about 14% of the portfolio's performance is explained by market movements. The next model is the same, but we add alpha. When we add alpha, we introduce a measure of the portfolio's excess return, meaning the return above what the market predicts for its level of risk. The slope, or beta, remains around 0.89, and we see a small positive alpha showing the portfolio earned slightly more than expected. Again, the R-squared is still low at about 0.13. So the market explains only a part of our performance. This indicates that the portfolio generally follows the market's direction, but it also benefits from other independent return drivers. The next model we look at is the monthly risk premium regression with no alpha. This model compares the market risk premium and the equity risk premium. The market risk premium represents the extra return investors demand for taking on market risk instead of holding risk-free assets. The equity risk premium is our portfolio's version of that. It's the monthly return minus the risk-free rate. The slope here again is around 0.89, which shows that our portfolio's excess returns move with the markets but with a bit less sensitivity. And the R-squared value of 0.14 means the relationship is positive but weak. So while the market influences returns, other factors drive much of the performance. Similarly, when we include alpha in this model, the results stay consistent. Alpha is close to 0, meaning the portfolio did not generate excess returns beyond what the market would predict. The R-square remains around 0.13, confirming that the portfolio's movements are somewhat tied to the market but not dominated to it. For investors, that means that returns are proportionate to market risk without consistent outperformance. The next model we chose to look at is the yearly excess stock returns using our monthly data. When we zoom out to a yearly level, we see much greater volatility. The portfolio experiences large swings between gains and losses with no consistent upward trend. This means yearly returns vary significantly depending on market conditions. For investors, that suggests this portfolio can do well in strong markets, but may also experience sharp drops during downturns, typical for equity investments. Our next model shows monthly rolling validity, which measures how strong the relationship between our portfolio and the market has been over time. In the monthly version, we see a steady decline beginning in the early 1990s and stabilizing around 0.25 after the mid-2000s. This means our model's predictive strength, or the portfolio's connection to market movements, has weakened over time, though it's become more stable. This could reflect changes in market behavior, evolving portfolio strategies, or simply a more efficient market. For investors, it signals that the portfolio has become less predictable relative to the market, but not necessarily riskier. In the next model, we switch to our daily data with the daily CAPM model. Switching from monthly to daily returns, we see a beta of about 0.92, meaning the portfolio tracks to the market even more closely on a day-to-day basis. The R-squared, around 0.18, shows a slightly stronger relationship with the market. This suggests that while our portfolio moves almost one for one with market returns, it still retains a small cushion of independence, which reduces volatility slightly. Adding alpha, again in this model, doesn't change much. Alpha remains small, and the R-squared is still around 0.18, meaning there's no statistically meaningful excess return beyond what the market explains. So even at the daily level, our portfolio performs in line with the market's expected risk-return trade-off. No major outperformance, but steady consistency. This next graph looks directly at daily excess returns, comparing again the portfolio's equity risk premium to the market risk premium, which were calculated the same way as in the monthly data. The slope is around 0.92 and the R-square remains around 0.18, nearly identical to the daily CAPM model. This reinforces that the portfolio's excess returns move with the market, but not perfectly. That's a good sign for investors who want moderate exposure to market risk without being completely dependent on market performance. This version is effectively the same, but it adds alpha, which is the excess return above what the market risk would predict. Alpha is effectively zero, meaning no meaningful day-to-day outperformance beyond what market risk explains. The last graph we have is the daily rolling validity, and it is very similar to our monthly rolling validity. In this daily version, we again see a steady decline beginning in the early 1990s and stabilizing around 0.25. As we said with the monthly, this means our model's predictive strength or the portfolio's connection to the market movements has weakened over time, though it's become more stable. And this is the same, or very identical as our monthly version as well. In conclusion, our analysis used several different models, including CAPM and multiple risk premium regressions, to understand how the Nike stock portfolio performs across different time frames. We found that while it generally follows the market, it does so with slightly lower volatility, limited alpha, and declining correlation over time. This means that it could be a potential fit for investors looking for consistent risk-adjusted returns rather than aggressive outperformance. Thank you for your time.